Stocks are lower after President Trump says he's increasing Canada's steel and aluminum tariff to 50%. These trade tensions and weakening economic data causing investors to go risk off and leading to an unwind of 16 years of U.S. stock market dominance. So far this year, international stocks are outperforming the S&P 500. Now strategists are downgrading U.S. stocks, both Citi and HSBC, taking them to neutral. Citi saying, quote, exceptionalism is at least pausing, and that two of their models triggered cautionary warnings. Meantime, HSBC saying, quote, we are not turning negative on U.S. equities, but we see better opportunities elsewhere. Joining us now, the strategist behind that HSBC call, Alastair Pinder, head of emerging markets and global equity strategist at HSBC. And Alastair, it's great to speak with you. This shift in sentiment has happened very quickly. What shifted the U.S. exceptionalism narrative that has existed for over a decade, in your view?
Yeah, thank you for having me. And I think, really the big catalyst, which has caused this shift, out of the US and into international stocks, is the way that governments are reacting to Trump's policies. I think the one thing that we underestimated is how governments were going to respond forcefully with fiscal policy. Now, we've seen that in China. We have the NPC meeting where they increased their budget deficit target. We're now seeing that in Europe as well, where Germany and the new coalition government are announcing their plans to do almost 1 trillion euros of fiscal spending split between defense spending and infrastructure spending. And honestly, this offsets a lot of the tariff headwinds that we thought would be materializing for these two markets, and really means that actually the growth backdrop may not be as bad as we initially thought.
One of the things I'm curious about, especially off the back of the announcement from Trump about an hour ago on Truth Social that he was increasing steel and aluminum tariffs and tariffs that would hurt Canada in particular, is the impact of the tit for tat and the trade war that is developing. Are you concerned about reciprocal tariffs leading to less resilience for that basket of European stocks?
100%. I mean, that is the big downside risk to our view, is that essentially this tit for tat nature on tariffs causes a much deeper, economic and global slowdown. And in that view, there's probably very few places within the equity space, both within the US and internationally, which would be immune to that. You would hope that, that essentially leaders would be aware of that and acknowledge the fact that the tit for tat nature could cause more downside risks. And again, focusing much like China has done, instead of necessarily going tit for tat, responding a little bit, but then actually focusing on what domestic policies they can do to offset some of the headwinds that they're going to be seeing from tariffs.
So is Europe still in a buying opportunity in your view?
Definitely. So I think you really got to break down Europe's outperformance year to date into two components. Really, from January to February, what we saw was Europe was outperforming because the euro was weakening. We went all the way from 112 down to 103. This was a tactical, momentum for Europe. But now we have something structural, which is essentially that Germany is coming out and saying, here is, a sizable amount of fiscal stimulus, which we're going to, deploy over the next 10 years. That, for me, is a game changer. That is a seismic shift in Europe's economy. And that's why I think you have a bit more longevity now in the European equity market trade. The final thing I'll just highlight is that obviously a lot of people are very concerned about the equity market exposure to tariffs, particularly in Europe. A few things to note. 25% of revenue in Europe comes from the US, but only 10% of that is what I would say is tariffable, right? The rest of it is services. The rest of it comes from companies that produce and sell in the US. So actually, I think European equity market exposure to tariffs is probably slightly less than what we think and is very sector specific.
If you believe in the AI narrative in particular, combined with your view, Alastair, that stimulus is a positive catalyst for markets, then why do you look at Europe as opposed to China as the beneficiary of that stimulus if you do want to take advantage of the AI trade?
So I think there's two different narratives. I mean, we're both overweight EM and Europe in this context. So I think both of them provide very interesting and compelling opportunities. We've touched on Europe and the way that they could be supported through the fiscal spending, which helps the domestic names. In China, not only do you have the fiscal stimulus, but you also now have this alternative AI trade, which is kind of materialized as a result of the development of the DeepSeek wave. And that's really catalyzing China's internet stocks, which, despite the rally year to date, still trade on just 16 times 12-month forward earnings, still cheaper than the Magnificent Seven. And I think a lot of investors are looking and seeing this as another alternative AI set, which we didn't have, 6 to 12 months ago.
All right, Alastair, we got to leave it there. Thank you so much for the breakdown of what's going on in European equities in particular. Really appreciate you making the time
Thank you
for
your time.
Yahoo
Thank
Finance.
you.